everybody. It's Mike Preston at New Harbor Financial. It is Friday, January 5th. And today we want to give you an update on the market and if one or two other items. Hopefully we can give you some wisdom and some insight into what's going on. So the market, the S&P 500 is on a pullback here. It's a very, very small pullback. And I'd like to share some charts to tell you a few different things that we've done in the last week. So the first chart I'm going to share is of the S&P 500. So the S&P has been on a pretty big tear here for quite a while, and we started to add some exposure here, very, very tactically and very much in a hedged way back here when we got this breakout of this downtrend line. We're glad we did. We adjusted our hedges or reduced our hedges, therefore making it so that hedges cost less at that point. When this happened, we changed our S&P 500 put. We've got a put on roughly 10% notional position in accounts down at 4,100, and of course the market just kind of went on a tear for a few weeks. It's been a pretty relentless move. And during this time, we've started to see a broadening of participation. Prior to this time, year to date, it's really only been the NASDAQ and the fabulous 7 stocks that were pushing the rally higher. But during this time, we started to see a broadening. We started to see small caps participate. The Dow started to join in the party as well. And we tactically increased our position in stocks up to around 37% or so. We did so partially by using an in-the-money call option on the S&P 500 equal weighted index. The equal weighted index started to participate as well. And this was also after our short-term indicators reversed up. So this market got really extended. And, the top here was basically on the final trading day of the year. So far, the S&P 500 has pulled back around 2%. And it's possible that we see a much bigger pullback. It's also possible, always possible, that we see a much larger drop or even a crash, because we're in constant crash-like conditions in this market. It's been one of the challenges that we've all been dealing with for so long. Valuations are beyond anything that's reasonable or beyond any level that could provide positive returns from here over the next decade. That being said, we have seen an increasing number of data that we look at that tell us that we could very well get an additional blow off top. So we'll see what happens here. We're well above the 50-day and the 200-day moving average. And because of this large move here, we had an opportunity to adjust our hedge on that 10% notional put protection. We moved from 4,100 up to 4,500 on the S&P. So even though I said we're around 37% or so in stocks on average, there is some dispersion across client accounts, but we're in the high 30% range when you count the call option that we bought on the equal weighted S&P 500. We added this hedge here and took the opportunity to move up our put protection to 4,500, and this expires in March. So when the market moves up, insurance costs less and less, and it gives us the ability to move up the floor. So this put protection effectively reduces our equity exposure down to 26 or 27%. Now, I should say that there's a small deductible that would be paid on that 10%. That is the amount between this point here where the market is currently trading and this line down here, but that's only a few percent. So that insurance protection would kick in pretty quickly. And so we'll see what happens here. The market is certainly overbought. If I go to the weekly chart, I think you'll see just how close we came to an all-time high in the market. So we came within just a few points of an all-time high. This is the previous July high back here at 48.16, and we came within a few points. So we're working on the first essentially down week here in many weeks. This is pretty expected. We don't know if this will continue down or not. If it does, we're completely prepared. I can say that our short-term indicators are still bullish. They're flirting with caution at this point, but it's kind of a mixed bag here. I would expect, just based on experience and sentiment and where we are in the cycle, that the market will try to make a new high, probably will make a new high, might even have a vertical move here to cap off this entire rally. This has been a bull market that will not quit, has not quit. The market here reacted in the last few weeks to what Fed Chairman Powell said about potential rate drops next year. The market expects 3 potential rate cuts. But overall, the market is incompatible with long-term returns. All we're trying to do here is make a little bit of money, make a little bit of return while this market is trending upwards. But at the same time, we don't want to abandon our discipline or our longer-term outlook that this market is likely to trade lower, much, much lower, frankly, in our opinion. Here's the monthly chart. So, the market has been relentless for many years. Post-COVID, we went off on the largest blow-off top I think that we'll ever see. I think very well we might get one more here, and we're prepared for it and tactically trying to participate a little bit without taking on too much risk. So we'll see what happens. We have established positions in industries and sectors that we think make sense. Industrials, we have uranium on board. A lot of these individual positions are hedged as well. So even though I said our net position in stocks is about 27% after that S&P put that we have in place as a hedge, even the remainder of that 27% has some protection in most cases through call options that we've sold against them. Let's take a quick look at gold, because gold continues to be, I believe, the best looking chart we can find. On the daily chart, gold has been flirting with making a new all-time high here for quite some time. If I go to the weekly chart, I think you'll see it a little bit better. So gold is still above 2,000 on the spot price. We made a new relative high here, but not versus this one last year. Probably best to show you on the monthly chart what this situation looks like. Going in each one of these sections here is 1 year. So over the last 3 years, gold has put in what many would call a triple top. Now we're flirting with making a breakout on this. Most triple tops don't hold. And gold has had this long, flat basing pattern. You could even see an inverse head and shoulders here after this long kind of cup and handle formation. This has been pretty frustrating to wait for because this is many years. But gold has been really strong, even despite relative US dollar strength in the last year or so. It's been really strong, has held in there. It's our view that gold is going to break out of this base. And it's going to break this triple top. We believe that gold is going to move higher towards around 2,500. And when that happens, that should pull gold stocks up as well. Gold stocks have really underperformed in this gold rally. It happens sometimes. I can say that gold mining stocks in general are at 10-year underperformance levels relative to gold. We believe when gold does break out, and we think it should, that gold stocks will catch up and move from underperformance to at least at par performance. And they could even outperform gold if investors take notice and start to pile in. This could push ETFs like GDX much higher. I'm going to move to a chart of GDX here. This is still a monthly chart. I believe GDX would move up to the 40 to 45 range if gold moves up to 2,500. And that's even if it moves from underperformance to potentially on par performance with gold. It could easily move much higher to the 50 to 55 range. We'd be looking to move our hedges up as this rally happens, which we think it should. We think that mining stocks could have an explosive rally. It's been a long wait. It's tried everybody's patience, particularly for gold bugs that have been believed in the sector for so long. But we're not relying on that to happen. We're participating in other ways, like I mentioned before, industrials, a little bit in insurance, uranium, 15% in emerging market stocks. Emerging market stocks are among the best valuations we can find anywhere in the world. So we ended last year with positive performance. It wasn't anything to hit the ball out of the park, but most accounts were up roughly 5% approximately. There again is some changes from account to account depending upon the size of the account. But overall, what we think the big picture here is to hopefully make a little bit of return when we can, participate if this market continues further, but really not take on much downside risk. Because we think the big picture, the big move is going to be lower in the market when it happens. And we think it's very, very late in this rally. We don't know how long it's going to go on. My best guess is maybe a month or two. So we completely stand ready to take advantage of short-term moves. Don't want to abandon, abandon our discipline on the downside. And overall, we have a plan on how to get into the market if we get that big down bear market like we expect. We plan to do it in tranches, slowly, in layers, with hedges as we go. We're above 40% or so in treasury bills and cash equivalents, and that's dry powder that we'll use on the way down. We continue to look at long-term bonds as an opportunity. We've got a smaller position there right now in TLT. We'll likely add back to that if we see a continued pullback in long-term bonds. We think the 10-year yield, which is presently around 3.9, could get up to 4.2 or 4.5, even in just a normal retracement. So the 10-year, remember, went from 5% to 3.8 in a very quick time. And that's because the bond market saw a historic sell-off. Really, it was a capitulation in my view. And so we took advantage of the recent rally in bonds and reduced the position a little bit. If we see a good opportunity, we'll add back to that position because we think longer term, longer rates go down to 3% or below, maybe even into the 2s on the 10-year. So that offers us an opportunity in long-term bonds. That will likely happen when the stock market is having a big drop. So we'll have to stay tuned and wait for that to happen. Lastly, I'd like to mention a book that many of you are asking about, The Great Taking, this book right here. So this book, written by David Rogers Webb, talks about what the Federal Reserve and other central banks have done to money and the markets over the last 15 years. It's been a long 15 years of constant intervention. And this book gets a lot right about how fraudulent the system is today after what the Fed has done, continually printing money, taking on debt, and creating the largest wealth disparity I think we've ever seen, certainly that we've ever seen in our lives. And that has societal impacts, and that's going to have impacts on the market. So we are preparing a full response. We'll release it at some point in the next few weeks. It's either going to be a written response or a video response to the book because so many people are asking about it. But in short, just to give you a small preview, I think the book gets a lot right about how badly the Federal Reserve distorted the economy and the markets. Markets aren't really markets anymore. They're a signaling mechanism for the Fed to make everybody feel like things are okay. But it's somewhat of an illusion because money isn't that real anymore. It's real right now, but I think that we're going to see a lot of what we expected was real wealth isn't really real wealth, and that it was contrived through money printing and intervention. And the wealth disparity that I talked about is very real. It's not fair. It's not just, and it's going to pose problems to us. Lastly, the end game for all of this is likely a collapse in which the public realizes that it was not real, that it was mostly an illusion. So, and it also introduces other risks like central bank digital currencies. I think that's likely if we have a collapse, if confidence in the Fed's money printing abilities is lost, confidence is lost by the public, then I think that we'll probably see a digital currency introduced. Where I think the book falls short is in an ultimate conclusion. The book essentially says that the stage is being set for all assets to be confiscated. I'm not sure that I see evidence of that. But like I said, we will provide a full recap to you shortly because so many of you are asking about it. So with that said, we'll sign off for now. Thank you for tuning in. We are glad to provide these updates to you every week about what we're seeing. And we stand ready to answer any questions and to meet with any of you anytime any of you have questions. We're here for you. So thank you very much, and we will talk to you next week.